Hello, everybody. Happy Saturday. Thank you for joining us in another Self-Directed IRA Saturday edition. We have a great presentation and speaker today we're super excited about. We have Randy from InvestArc Properties talking on understanding the capital stack for passive investors. We're really excited about it. Can't wait to start. Before we pull him up, though, I want to welcome you guys, tell you that, my name is Andrea and I'm an IRA specialist here with Quest. If you'd like to put in the chat where are you joining us from so we can see you guys and also your names. And then you'll be able to enter your questions in the chat, please, throughout the presentation. And then Randy will get to them at the end. And if it's anything IRA related, I can step in as well. But yeah, let me go through a couple of slides here that I have prepared for you guys before we get started today. First off, we have a rewards for deposit promotion going on until the end of this month, which is amazing. So if you're still, looking to move in funds, now is the best time to do it. This is for both clients and new clients. So, go ahead and take advantage of this, guys, because it's really big. Here's kind of the explanation, but basically starting from $100,000 moving in, you get credits on your accounts. So we also are showcasing our gold family department. It has amazing features. You work more with one-on-one with someone from that department. You have a dedicated person with you and with your investments, so it makes it a little bit easier. So make sure to check this out. And if you have any questions, of course, reach out to us because we'll be happy to go deeper with you guys into what this whole experience is about. Of course, we have our Elite Multifamily Summit coming up in Dallas in August. It's coming up very soon. It's going to be amazing. Lots of great information, amazing panelists, so lots to learn. It'll be a closed door type of event, so you can ask all the questions that you want and you need. It's early bird, I believe is over, but get to me if you're interested in joining us and would like to purchase a ticket at a discount, because we still have discount codes. So reach out to me, and I'll put my email in the chat in a second. And then, of course, we are telling everybody to save the date for our next expo in June of 2024. This is going to be a huge one as well. It's going to also be in Irving, Texas, so in the Dallas area. Can't wait to see you all guys there. So without further ado, let's bring up Randy. He is a general partner in about 1,100 doors, representing 110 million in assets under management. So we're really excited about his presentation today. His investment strategy focuses on providing the passive investors significant returns by improving communities using a safe and time-tested approach. So Randy, thank you for being here and for joining us. Take it away, please.
Well, thanks, Andrea. It's really a pleasure to be back at Quest again. It's kind of like coming home because I started with Quest in terms of investing. So I really appreciate the opportunity. And for the listening audience, we're going to be talking about the capital stack. And before we go real far, though, it'd be really helpful if anybody's in the audience, if my simple question feedback would be, I'd really appreciate if you could tell me, have any of you done any investing already? Are you into apartments or not at all? It would be helpful if you could tell me that in the chat just to get a little feedback. And while you're doing that, and I'm looking across at my other monitor here just to see the chat, but the agenda's before you here. I'm not going to read it all to you. We're going to work through this. And as Andrea said, love for you to enter any questions in the chat during the presentation, and we'll get to them at the end. I can stick around for a long time if necessary and bore you to death, but let's go. So a little further introduction. I started InvestArc back in about 2014 when I was really looking to develop another passive income stream, and found that I needed that because of where I was at, and I'll get into that a little bit more about that. My background, I learned the business. I started at Lifestyles Unlimited in Houston. I went to the Sumrock Group in Dallas for several years, where I really cut my teeth on multifamily and learned underwriting and building a team. And today I'm part of Rod Khleif's mastermind. And so I think I bring to you a perspective with a couple different educational groups, as well as I'm a personal coach in multifamily along with that. And as of until the end of April of this year, 2 months ago, I was employed. I had a W-2 job and subsequently left that to focus 100% on multifamily here and what I'm doing today. So enjoy the opportunity if anybody ever wants to talk about that. I took the pretty traditional career of getting started. My father and mother told me get a good education, go to work for a big company, work hard, hopefully get promoted. I got some advanced degrees along the way there. And you realize at the end of the day, though, that doesn't mean anything in multifamily. I know people that have a lot fewer degrees than I do and are more successful. So don't let that be a hindrance. But and I wish I had developed this paradigm shift a lot earlier in my working career to be more entrepreneurial and more into real estate. My wife always reminds me that I don't talk about my family when I get on these. So I need to tell you that just the personal side, I'm married for a long time. I have 4 adult children, 5 grandchildren, and just happy to be here again today. So my journey started, like probably many of you, as I said, trying to find a different income stream. And I started out doing single family flips. I was a hard money lender for single family flips with a partner and I. And we had developed a process to do that. And I started to work into multifamily, and that's when I found Quest. So my first several investments were all done through my IRA because I didn't want to use my spendable income. So a little sales pitch there, but also it's a venue when I talk to people still today that say they don't have any money. I say, do you have an IRA? And it's a great place to invest. Andrea talked about what I'm doing today. Goals down at the bottom. I wrote this goal at the beginning of 23. I had no idea how I'm going to accomplish it. I'm still working on it, but I hope you're writing big goals for yourself too, for the remainder of 23 and into the future. Now I'm trying to get to advance. There we go. So why is the capital stack important? Really because as an investor, I want to take a little deviation here of developing an investment strategy for you. And it's important for you as an investor, as a potential investor, to really have a strategy. Who are you going to invest with and where are you going to do? And it starts with knowing the sponsor. What are their philosophies? So you as a passive investor really need to focus on that first. Know the markets, the methodologies they're into, who are their partners, what's their experience. You really need to gather their experience, and you need to understand the numbers, right? Because the numbers really do matter. Make sure that before you make any investment, you understand the risk parameters and how the income producing is going to happen. You need to understand their underwriting assumptions a little bit in multifamily. What are their rent and expense growth assumptions built into it? You'll find that everybody says they're very conservative, but one man's conservatism is another man's liberalism. So you've seen one, and it's buyer beware. So make sure you know, like, and trust them and understand it. What are the fees in the acquisition? We're going to talk a lot about the capital structure today, and we'll do that. But just make sure that you're an investor, not a speculator. So you need to understand the risk, at least until you gain a little more confidence before you jump in real heavily. So we're going to jump into the capital stack right here. And really what we're talking about is apartment syndications. There's the arrow pointing down on the left is the return, obviously, and that's pointing down. And the arrow on the right is risk. And so the less return on the left side, I'm sorry, the senior debt has the least amount of return and the least amount of risk down here at the bottom. And conversely, up at the top, the common equity has the greatest return and the greatest amount of risk. So as you progress upward on it, you go rate of return and rate of risk. And so first, what's the senior debt? The senior debt is really just that. It's the bank, it's the lender, probably disproportionately built here because the lender really is going to represent anywhere from 60 to 80% of the total capital that's needed when acquiring one of these properties. Mezzanine debt is just that. Notice the word debt, it is different than equity. So it's a loan. It's another type of loan. In commercial real estate or in multifamily, it's generally a supplemental loan or a secondary loan on the property, but they're going to get paid first. Then the preferred equity, and notice the word equity again. So that's your owning part of it, but you have a preference over the common shareholders. And so starting at the bottom, they're the ones that are always going to, the banks and the loans the debt lenders are always going to get paid first on any proceeds. When it's sold, they're always going to get their money back. They're seldom going to lose. The preferred and common equity shareholders share more risk, but they also have a much greater return. So think of it, a bank lender is going to make 3, 4, 5%. Common equity is going to be looking at making 17, 18, 19% IRR on an investment. So much greater return, but with it comes some risk. So we really need to understand what we talk about when we say what's a preferred return and why is it important. Well, first, I talk to a lot of new investors, and many get confused and think that a preferred return is a guarantee for payment, that it's really something that is guaranteed. And we'll see here that it's really not. We need to understand the capital stack and how the flow of funds happens in these investments so that you are an informed investor versus a speculator. And when you see an investment pitch deck come out from someone, it is a pro forma. It's a projection. It's a projection as if all of the assumptions are met. That's what the returns will be. So just be advised that those projections don't have correlation to past performance. Always the disclaimer we always say is past performance is no indication of future success. So though you invest with people who have a track record and have success, it's a business and there are risks. We need to make sure that you as an investor understand cumulative versus non-cumulative preferred returns. It's pretty much just as it says. Cumulative means that if you don't meet that rate in year one, it carries over and is cumulative until year 2, year 3, year 4, until the property is actually sold. So it accumulates over the life of the asset if you don't hit it. And non-cumulative is just that. So if I have a preferred distribution and I don't meet that benchmark in year 1, it doesn't carry over to year 2. So you really need to understand where the cumulative returns are. Majority of them are, but you need to understand to read the legal documents that you're going to be investing in to make sure. It should be one of your checklist items as an investor. So what is a preferred distribution then? It's really how the distributions are paid out, how profits are paid out. You got a pile of cash and you're paying it out. Who gets paid first to what? And we'll talk a lot more about that. We talked about the LP investor or the limited passive investor. I use those terms synonymously, are not equity. They are equity. They're in an equity position. They're not debt, excuse me. So the order of priority is always going to be to pay off debt first, then equity. And you get paid as an equity player after all the expenses, all the fees, all the debt, all the capital improvements. You're paid out of free cash flow. And that's what makes commercial real estate so enticing is you're paid out of free cash flow, and how much the property is generating varies from property to property. Some very little, others immensely. And so only do you get paid out of the free cash flow. So if there's no free cash flow, you're not getting paid. And again, if there's a lot of free cash being generated by the property, you're going to get a lot. And that's what we all want. But think of a preferred return as really a hurdle, a benchmark, a target for where the general partner begins to share in the distribution of funds. So in a very simple example, the preferred equity player is always going to get paid before the common stock. And if that hurdle is, say, 5%, they're going to get their 5% before the common stock, the other equity players get any proceeds at all. And it's also common to see that the limited partners can sit in different classes as we go through this model here. So I'm a general partner in many, I'm a general partner in about 1,100 doors. I always invest as a limited partner because I think general partners should have skin in the game. And so I make sure that I have skin in the game, and I want my investors to know that. You should ask your investors that. So don't be alarmed if there's general partners also acting as limited partners. That's very common. So here we're going to start talking using that same visualization, but we're going to say the simple capital model, simple stack, referred to as the simple stack, the 80-20 plan. So again, we have our visuals with the return on arrow pointing down on the left and risk pointing up on the right. And we got senior debt at the bottom of the stack. And they put in 80% of the purchase price. They put in 80% of the purchase price. And they've got the least amount of return and the least amount of risk. So again, they're going to make 3, 5, I don't know, today maybe 6%. And then in this model, we call it the simple stack because it's just simply split between the Class A and Class B shares, or the limited and general partners. In this situation, the limited partner is going to get 80% of all the free cash being generated from the property. And the general partner is going to get 20%. So the advantage of this is just the simplicity of it. The simplicity of it in that everybody, when there's cash to be distributed, everybody gets paid at the same time. It doesn't matter of your rank or your position. And the limited partner in this model gets a higher percentage. They're getting 80% versus, we'll see in the next slide, a lower percentage. So just keep that in mind. And remember the risk versus return scenario as we go forward. So now we introduce the concept of a preferred return. Again, on the left, same thing, return down, risk up. The senior debt, again, in this example, put in 80% of the purchase price. If it's $1 million, they put in $800,000. But we introduced this Class A equity member, which is a preferred equity. They're the limited partners, but they're getting an 8% preferred return in this situation, in this fact pattern. So that means that they get any cash flow, the senior debt is going to get paid first, or if there's mezzanine / supplemental, then the preferred return, and they get paid up to 8%. And once and only once they get their 8%, does the Class B or the general partnership get paid. And they get, of the remaining cash flow after the 8%, it's split 70-30 between the general partners and limited partners. So very simply, it's an order of cash flow. And here it's a 70-30 split. The advantages of this model is that you see the limited partner getting paid before any money goes to the general partner. So in many situations, this is preferred by investors because they see their interest being served before that of the general partners, which makes a lot of sense. I have a really good friend, prominent syndicator in the U.S. who, as a limited partner, says he won't invest the simple capital model that we saw stack in the first slide, 80-20, because it doesn't have a preferred return. I personally disagree with him because I think there's a disadvantage to this model as well. So the obvious advantage is that you get paid first, but the disadvantage is if and when property ever starts to run into troubles and runs into problems and the general partners get behind on the pref, let's say they can only pay 1% or 2%. I've seen it where the general partners take their eye off the ball and they start looking to the next transaction of how they might get paid or get a higher fee on the next engagement versus writing this property that's potentially has problems. And so they're working without getting compensation. And I personally, I don't like to work for free. I hope you don't either. And so there's pluses and minuses to each model. You just need to be aware of them and make sure that you know the key factor again is, as we talked about, know the general partners up here, who they are, and the character of them to the best of your knowledge, and do you trust them? Okay, so now we got what we're going to refer to as the complex model. Here is the same illustration we've been carrying. Senior debt at the bottom, 80% of the investment capital has been put in by the bank or the lending institution. But now we introduce this stack at the bottom called a 10% preferred. It's a class A. It's an equity stack. It's an equity. It's not debt. It's equity. And they get 10% preferred return. But they don't share on the upside of the sale, on the back end of the deal. So when the deal is sold 3, 4, 5, 10 years down the road, they don't get any proceeds from that sale other than their 10%. They get 10% each and every year of the deal, and that's their reward. Then we continue up the stack, and you see the same model. The Class B is limited partner. In this example, they get a 7% preferred return, but they do share on the upside of the sale 3, 4, 5, 7, 10 years down the road. And that's what differentiates them from the Class A shares. They get a lower return, but they share more on the back end proceeds, assuming there's a lot of cash there in the back end. And then there's the traditional 70-30 split here between the limited partners and the capital partners of any remaining cash flow. So what's the advantages of this model? Well, the advantages are pretty simple. For the common Class A shareholder, they're the people who have had, my experience has found, they're individuals that have a lot of money and they don't need the large equity kicker. They just are more interested in income preservation versus potentially losing it. So they want a high rate of return, 10%. My one friend says, Randy, I've already won the lottery. I don't want to lose what I have. I just want to maintain it and make a healthy return. So he's willing to accept 10% cash on cash return each and every year. And then the common equity, again, they're the traditional LP investor who's going to get their 6% preferred return. And after that, if there's any free cash flow, it's going to be split 70-30 between the Class A and Class B, or the Class B and Class C, or the GPs and the LPs. Hope that makes sense. And if not, I'm looking over to see if there's any chat items there on that. So with this distribution, this here is just a visualization. And what we're saying now is we're going to introduce the concept of a waterfall. And the first column is really what we've been talking about. That's the cash flow from operations, month to month, year to year. But now we're going to introduce the concept of a second column of proceeds coming out of a refinancing of the deal, or in the third column, proceeds coming out upon the sale of a deal. And if that happens, you'll notice there are more rectangles here. And this is meant to be an illustration of a waterfall of items flowing down through that. So what does that kind of mean? Well, a waterfall is just kind of as you would imagine, water cascading down. It fills one bucket. When the first bucket is full, it flows into the second bucket, and when it's full, it flows into the third. So only when the buckets get full does it flow into the next level. So in that illustration, if there's not enough water to fill the second bucket, it fills the first bucket, which is debt, the bank. And after that, there's nothing left. Everybody's a non-winner. But hopefully there's a lot of water to address this, and we'll give you a visualization here to hopefully show that. So this waterfall is spelled out in the documents and shows how the distribution of assets is going to be distributed. It's often used in the context of hedge funds or private equity, which private equity is which most real estate PPMs are. And there's 4 different buckets in there that we talked about. There's the return of capital, preferred return, the split, and the hurdles. And we're going to go through each of those and show you a visualization of that and help you understand it. There's 2 kinds of waterfalls, just so you know, American and European style. I'm not going to cover the European style model because it doesn't work today. We're sticking purely with the American model, and we're going to talk about it here. So we covered this one. That's the cash flow that's coming out. That's the simple and the complex capital stack. But here on the finance waterfall, all we're going to do is we're going to assume there's a big pile of cash coming in from a refinance. The property's been refinanced, and I don't know, 100% of it or 60 or 80% and it's first going to go to pay back the investors' capital. So the investors, the LPs, capital investment always gets paid back first. So if you put in $1, you got to get $1 back before anything flows into the second bucket. And then the second bucket is where the preferred return is played. And it only then does the preferred return kick in if it's a 6%. All the proceeds from that refinance first pay the refinance in 1, and in 2, the second bucket shows the preferred returns being cumulatively caught up. And then the third bucket shows pretty much the 70-30 split, or in the example we talked about, where the investors share 70% with the limited partners and 30% with the general partners. And the fourth bucket really shows the hurdle rates of how the split happens after that. And so pretty much the refinance column and the sale are the same with 4 buckets. So you could refinance the property, which is, if the property's doing great, it's a very common strategy to refinance it, take a supplemental loan in year 3, 4, 5, give a bunch of money back to the limited partners, and maintain the property for another 3, 5, 7 years just to take the cash flow. That refinance is just a tax-free event, which is always great. There's a great outflow of cash from it, and everybody wins. And imagine if you held that for another 3 or 5 years, and then it came to a sale, and you repeated the same thing. It's a very lucrative arrangement when it happens and the property is that successful. So those buckets, as I talked about, the first bucket is the rate of the return on capital. Very simply, that's the investor's capital. That's what they put into the deal. So 100% has to go back to the investors to be made whole on their initial investment. Then the second bucket is the preferred return to meet the hurdle. Then the third bucket is the limited partner and the general partners, right? So if it's a 70-30 split, that's where they're going to split 70 and 30% of the proceeds after capital, after the preferred return is paid. And the fourth bucket is this hurdle rate. They're not in every deal. So as I said, you've seen one deal, you've seen one. Read the documents. It's in the PPM or the private placement memorandum. And it's usually defined as an internal rate of return, or IRR. And usually the way I've seen it is, if an IRR hurdle rate of say 16, 18, 20% is achieved, the split then goes from 70-30 down to 60-40 or 50-50, or however it's defined in the document. Each one is different. This is generally referred to as the incentive of the general partner to beat the pro formas. So, and this is generated because I've seen many examples where the general partner has made a 50, 60, 70% IRR, just huge profits to the partnership. And it's perceived that they've added the value to this by running the show and rewarding the investors, so they should share in the proceeds more with it. And so, right or wrong, that's the way it is. So back to this visualization for a refinance of all we've been talking about is a big pile of cash up here from a refinance, big pile of cash. 100% of it goes to the limited partners for their initial contribution only, 100% back. So if you only got enough to pay back 20% from a refinance, well, none of the other buckets get to participate in the refinance waterfall. So here we're going to assume that there was enough in this pile of money to pay back everybody 100%. And then the next hurdle is you're going to pay back to the limited partners their preferred distribution or a hurdle rate that's there then been defined. So if they've been behind, they haven't met their preferred rate of, let's say it's a 7% preferred return in years 1 and 2, they only paid 3%. In year 4, they refinanced it. Well, they've got to catch that up, and that's going to come out of the next layer of proceeds, assuming the proceeds are available from this large pile after paying back the initial capital, then what's left. And if there isn't, then there's no split after that. But assuming, again, there's money from this initial pile that has cascaded down into the bucket here, then it's split. Anything is remaining is 70-30. 70-30. And so, as you can see, it all depends on the amount of cash in this pile of money up here to start with, of how the distributions are really made. So now we add in the fourth layer here. Let's say it's upon the sale. Same pile of money, it's starting at the top. We return all the investors' money. We catch up on all the preferred returns. We split the money 70-30 up until a hurdle rate, in this example, of 18% is achieved. So if you have an 18% IRR, you're more than doubling the investors' money already. And so after you split 70-30 up to 18%, but after 18%, it's split 60-40 or 50-50. Again, that's the incentive to helpfully incentivize the general partnership to do more. And so I hope that's helpful, the visualization of that, and helping you understand that. And so here what we've done is kind of a catching up and showing this all together here. On the left is the water flow from operations that we talked about early. It uses the simple capital stack of 80-20. Whatever money is going to be distributed from operations is going to flow 80% to the limited partners, 20% to the general partners. The refinance captures all this in one visual here. So we got 100% return of initial capital after we've achieved 7% in this example preferred return. And assuming there's cash left over, everything's going to be split 70-30 there between limited partners and general partners, 70%. And if there's still money left over up to that hurdle rate, it's going to be split 60-40. So, and then the sale waterfall on the far right column is the same illustration to help understand that it's just a different capital event. It's a sale versus a refinance. These two are pretty similar in nature, except that different events. So how's this work? It's pretty simple. Make sure you as an investor understand this before you get in something as to what the distribution of cash flow is. It should be in the financial section of any investment summary. And I always say, if you don't understand it, ask. And if your general partner or the sponsor is reluctant to ask the questions, I'd say that's a red flag that you ought to be looking into more. But so read the documents, read the private placement offering and the operating agreement to understand, and it will spell out in there cash flow from operations and cash flow from a capital event, such as a supplemental loan or sale, and you'll see how it is. As I said, no two are the same. They may have some similarities between them, depending if you're using the same general partner, but generally they're different. Make sure you know. Read the documents is the bottom line. Ask. And so that really concludes. Happy to answer any questions if there are any. I got you a QR code here that you can snap a picture of if you want to reach out and contact me. Happy to do so. But it's been a pleasure. And Andrea, I really thank you again for the time. And we'll see if there are any questions come up in the chat here. Hi, Jimmy. I see you've been investing for 10 years. Congratulations.
Thank you, Randy. Yes, we have comments more than questions. So I'm just displaying them on the screen so you can see them. But
Trevor,
thank you very much. That was a great question.
Yeah.
So yeah, if anybody has any questions now, it's a great time to ask. We'll stick around for another, few minutes to see if anybody else comes, has any other question. Otherwise, we'll end here shortly and give you guys back some time on this beautiful Saturday.
Certainly, I couldn't have been that clear with my presentation. There has to be a comment or so. It's all right.
So where are you located, Randy?
I'm in Houston. I'm in
Okay.
Houston.
Awesome.
Where it's nice and hot. Like I think you're in Houston too, so you know how hot it is.
Oh my God, yes, it's been crazy. Yeah. We have UDFI consequences here. If you'd like to touch on that.
UDFI consequences are really the consequences of using your self-directed IRA, and so. Yes, when I first got into it using, and Andrea, you correct me where I'm wrong here, but when I first got into it and started using my self-directed IRA, I was told that it was a total tax-free event. You're using an IRA, and so, well, that was a lie. It's not a total free event, tax-free event. So, yes, to the extent that the government won't allow you to use two vehicles, a self-directed IRA or an IRA, and the concept of leverage in the same deal to propel your returns. So to the extent that you use leverage in a real estate deal, which they all do, anywhere, as I said, between 60 and 80% is going to be the leveraged amount by debt that is going to be considered a taxable event and so if you invest $100,000 and 80% of that is taxable, 80% of that is debt, let's just simply say, of the asset. 80% of your returns are going to be subject to capital gains tax under the UDFI, very simply, within the self-directed IRA. And then you have to file a separate tax return to do that, which is the 990T, and which Quest will make sure you do, so that as the custodian that we're all in compliance. But you have to find another tax preparer that will prepare a 990T. Because of many of I know I'm a CPA and I wouldn't touch it, but I know even my guy that prepares my tax returns won't do the 990T. So there are ones out there though in Houston and elsewhere that we can help you find.
That's correct. So if you guys need good CPAs to help you guys with these, please reach out to me. I have some good contacts that I can share with you guys. But yes, that's basically in a nutshell. That was really good explanation. And of course, there's some depreciation tactics that you can use to offset this UDFI that's within an IRA. So yeah, make sure to reach out if you need more information on this. We actually also have some great educational videos on our YouTube channel that they go deep into these subjects of UDFI and UBIT. Okay, so check those out as well. And then we have Jimmy Summers here.
In your experience, how are you seeing the rise in interest rates impacting multifamily investments? Jimmy, that's a great question. And I want to give you kind of a sarcastic answer that if I had that much wisdom and knowledge, I probably wouldn't be on this presentation, but I think it's good and bad. So the rise in interest rates meaning we have inflation, though inflation is coming down, but inflation can be good as a property owner because that means we get to charge more in rents too. And so on the inflation side, I think it's really distinguishes a good operator from an average operator, because a good operator is going to manage that delta between the income and the expenses better. An average or poor operator isn't, and the increase in expenses because of inflation is going to rise and cause that issue. I think you can mitigate the risk too by on the interest rate side with I myself have taken out several loans in 22 on properties that have rate cap insurance on them. So if interest rates have gone up, and we've been protected by those for 3 years. But I think that also signals that variable rate debt today is out of favor, and in the future, I wouldn't do one with variable rate today. So I think that's an implication. But to date, interest rates have risen, but property prices have not fallen yet, and tenant rental premiums or rental haven't fallen yet either. Some market specific, but for the most part, the rises have just flattened out or become flat altogether. So there's pros and cons. I think if we start to see true asset prices decline, we're going to be in trouble. But heretofore, we've really held the line on that pretty much across the country. I mean, it varies property to property, but a long-winded explanation, but I hope that helps some, Jimmy.
We have Nagarath Prayer here saying very well presented. And then we have a few more questions. So let's, I'm going to put them on the screen here from Catherine Taylor. Yeah.
There's Catherine, if there's a capital call during an investment, does the LP have to add additional money? The short answer of that one is read the PPM or read the operating agreement. Read the operating agreement. The majority of them that I have seen are not required, but the consequences of not participating are that your investment is diluted. So if there is a capital call on a property, read the operating agreement, because it'll spell that out for you. Find it in the operating agreement what happens if you don't participate. But most likely, if they need to raise money, whatever money is raised is going to dilute your capital share if you don't participate.
Interesting. Good question.
Well, Athena, what's Randy's company name? What happens to taxes when the syndication sells the asset? My company name is InvestArc Properties, and it's in that QR code right there. You can contact me there. That's got all my information there. What happens to taxes when the syndication sells the property? So there are a couple things there. When the syndication sells the property, they're going to pay the real estate taxes and associated with the asset there upon the sale to clean that up for the syndication. But then the gain is distributed to the partners via a K-1 tax return, and each partner is going to share in the gain correspondingly to their capital allocation or their capital percentage rate. And that would be reflected on your personal taxes and flow through, assuming it flows through to you. So to summarize, it flows through the K-1 to you as the investor, and you're dealing with it on your own tax rate there. And I would editorialize then, that's where you want to begin to accumulate a portfolio of these investments, so that a lot of the reasons we do this is defer taxes. So if you have a portfolio of passive investments, you get multiple K-1s. And let's say you have 5 properties, 4 of them, and most likely until the property is sold every year, because of depreciation, you're going to have some form of a loss, a paper loss on your K-1, hopefully a positive cash return. But you have a paper loss, and if one of those properties sells, you can offset the gain from the sale against the losses from your other properties and thus create pretty much a tax-free event. And you just have to keep reinvesting your dividends, or your proceeds. But so the answer is just simply, to your question, it flows into the individuals. Talk to your tax professional. I'm not a tax guy, but talk to your tax professionals. They can more eloquently give you information than what I just did. Randy from Fabian, do you prefer personal consultants? If so, what is the best way to reach you? Do you do personal consultations? I'm sorry. I am a coach. So again, the QR code, you got an email there from me, my phone number. Reach out to me. We can discuss that. I'm happy to talk to you about that. I do personal consultations. I am a coach, as I said. So happy to discuss that possibility if that's of interest to you.
Awesome.
Mike, how can I learn more? Resources, books, educators. Great question. First of all, learn more about what multifamily or the capital stack, but I'm going to assume you mean multifamily. I'm going to even do one better than that. I think it's the book. I'm reaching up to my cabinet here. The one that I really would encourage you to look into is The Hands-Off Investor by Brian Burke. The Hands-Off Investor by Brian Burke. This is more of I like it because it's kind of a technical, right? It'll give you a lot of information about passive investing generally and how to evaluate deals. So that's the book that I really like. The second one that I would recommend is, I can't find it right now. I've lost my train of thought, but that'll get you going, Mike.
If I may, I also like to say we do have a lot of educational videos on our YouTube channel as well on all things multifamily. And I know there are usually, they touch on self-directed IRAs, but then there's also ones that are, on due diligence on different topics on multifamily investing. So if you want to check that out, that's also there for you.
Fabian, how current high interest rates are impacting multifamily investments closed in 21 and early 22? Not sure I understand that question. How current high interest rates are impacting multifamily investments closed in 21 and closed. Okay, so I'm assuming you're buying closed. I thought you meant selling. So you bought an interest rate in 21. You bought into a property that closed in 21 or 22, and I think it goes back to if you bought in that time period, you most likely bought with variable rate debt, and so hopefully the property has rate cap insurance to protect you as the investors that the general partners should have purchased. And if they didn't, I hope the property, I'm in one of both. We purchased a rate cap as a mitigating factor, and the other one we didn't. I'm thankful the one that we didn't have a rate cap insurance on, it's just generating a lot of cash and it's covering the increase in interest rates, right now. So it is affecting, if you got fixed rate debt, that's a blessing. If the general partners got fixed rate debt in 21 or 22, most likely they didn't, but that'd be a blessing. And talk to your general partners and read the investment decks and the investment newsletters that the partners are sending out.
Awesome. Well, we have Athena saying thank you. I was afraid of that. And also Fabian, great information. Thanks for sharing. And then we have Mike Carpenter saying multi is my interest. So that brings us to the end, I believe. So thank you very much, Randy, for being here with us. And thank you, everybody, for joining us today. Any last words, Randy?
Simple thanks. It's been fun. I hope the audience got some kernels of wisdom out of it or something they can take away and apply. And again, reach out to me if you want to talk more on the QR code.
Thank you, Randy. Hope we can have you again soon in the future. And here's Randy's information, QR code if you need it. And if you need Quest, you know where to reach us. But thank you very much, everybody. Hope you enjoy the rest of your weekends.
Have a great day.